Good afternoon and welcome. Thank you for taking the time to attend our webinar. Today, we will explore the benefit of having a personal pension plan if you are an incorporated professional or business owner. My name is Godfrey, Wealth Planner at JCIC Asset Management. At JCIC, our priority is to provide financial planning strategies and investment management to help our clients grow their assets and maximize their wealth. Throughout this presentation, if you have any questions, please feel free to use the chat function and we will do our best to answer them for you. Now, I'm very excited and honored to introduce JP Laporte from INTEGRIS Pension Management as our speaker today. JP is a pioneer of the personal pension plan. He has over a decade of experience as a pension lawyer and have dedicated his focus on the personal pension plan strategy starting back in 2004. As a result of his work, he was awarded the Queen Elizabeth II Diamond Jubilee Medal by the Governor General in 2012 for his effort to improve retirement solutions for Canadians. So without further ado, JP, welcome and thank you.
Okay, so thank you, Godfrey, and let's hope that this is educational for our attendees and those that will be listening to the recording. The case study today is really dealing with a business owner who is incorporated and has a fork in the road, has a choice whether to continue on using the RRSP as the primary way to save for retirement or thinking about upgrading to using a personal pension plan. So in order to understand why so many business owners are starting to do these types of PPPs, it's important to understand the mechanics, what's going on under the hood. So this is why the case study is a great way to provide that information. So if we could go to the next slide, the case study, I'm going right to the details. We're dealing with a 45-year-old who'd like to retire at 65. So we've got a 20-year accumulation period. I could have made that 71. I could have made that 60, but I picked 65 because a lot of people use that age. The business itself is generating about $1 million of top line taxable corporate income. But once you factor in all the expenses, really what's left for the shareholder really to spend for themselves is $500,000. And then out of that, they want to pull out $150,000 in annual living expenses because they need to pay their mortgage, they got to pay their bills and so forth. Now, this 45-year-old has a 20-year-old child who could be put on the payroll of the family business. This business is in whatever it's in, and there's a way of having the 20-year-old child employed. And you'll see that comes in later on. Now, this particular investor is a balanced investor, meaning that they don't want to take too much risk, and they're happy if they can get a consistent 5% return over time. They're more than happy. They don't like to lose money. So, and a few more facts just to round out our case study. Up to this point in time, from age 18 or whenever they start working until age 45, the business owner has accumulated $300,000 in their RRSP, and those RRSPs are growing at 5% as well. For the past 10 years, from age 35 to age 45, the business has been paying that $150,000 salary to the person, to the employee. He doesn't have any, or he or she doesn't have any RRSP room because he's maxed out. Now, remember I said there's $500,000 left over after expenses have been paid. $150,000 goes to the salary, so the balance is retained earnings. Some of these retained earnings are invested by the corporation inside the corporation's non-registered corporate investment account. And with that $100,000, they bought some shares. We'll get to that later on, but that's just to map out sort of the big picture. Next slide. So this particular business owner is now, as I said, trying to manage personal tax because they're getting a salary and corporate tax, because the corporation as a separate legal entity has to worry about its tax bill. So there are two optimization issues that need to be considered. So if you look at the next slide, what happens when the corporation decides to set up the personal pension plan? Well, right out of the gate, instantly in the first year, we have three initial tax deductions that are triggered. There's a past service buyback, a past service deduction. There's the annual contribution for the first year. And there's also what we call the RRSP double dip, the fact that this individual can also put money in the personal RSP on top of using the pension plan for these first two deductions. So let's break that up a little bit more. Let's get into the details. So when we run the math, remember I told you that he's been collecting a salary of $150,000 for the past 10 years. That's the buyback of past service. So that will give the corporation an immediate tax deduction of $79,647. Now, of course, if we had bought back 20 years, there would be more. If it had only been a couple of years, this amount typically would be much smaller. We just picked 10 years. So that's number one. Number two, for 2024, let's say we start the plan retroactive at January the 1st, 2024. For 2024, based on his salary of $150,000, based on his age of 45 years of age, the company also gets an annual contribution of $30,480. And then remember the third one, the RSP double dip. He or she also has an ability to put another $7,500 in the personal RSP and get a personal tax deduction. So if you tally up all this in year one, we're at $117,000 of tax deductions versus the status quo of just doing an RSP, which is $27,000, because 18% of $150,000 is $27,000. So right away, we've got a significant gap. Now, there's a little bit more to it. Remember that when I was telling you about the assumptions, I said that he has $300,000 in the RSP. When we're buying back past service, often, not always, but often, the CRA forces us to transfer a portion of our existing RSPs into the pension plan. And that's called a qualifying transfer. So in this case, using these facts, the qualifying transfer is $256,000. So out of the 300, 256 goes into the pension plan. The balance can stay in the RSP, or it could also be transferred into the pension plan. It would just go in a separate account. So under the pension plan, the personal pension plan, we have what's called the defined benefit account. And this is where the qualifying transfer goes. And then we have a defined contribution account, which we're not going to talk about today. And then we have a third account called the additional voluntary contribution account, or AVC. So the $44,000 that wasn't required for the qualifying transfer can go into the AVC account. Now, why is there a qualifying transfer? It's because the government wants to ensure that the tax system is fair for all Canadians. And it would be unfair in the eyes of the government if, on top of having used the RSP system throughout their life, a business owner could also multiply their tax deductions using a pension plan and not get any penalty for having done that. Because it would be like some people are considered to be superior to other people. So the government tries to equalize things by saying, well, if you're going to have a pension plan, but you've used the RSP system in the past, some of those RSPs have to go into your pension plan, right? So what it does is it creates some more equity amongst taxpayers. Next slide. All right, but we're not done, because we start with the three initial, but there are more contributions, more deductions. One is what we call special payments, and the other is called a pension adjustment offset amount. So let's decompose some of that a little bit more. What is a special payment? Well, a special payment is an additional corporate contribution to a pension plan if the assets that are invested inside the pension plan have a rate of return that's below 7.5%. The logic here is that the government expects the monies that are contributed into the pension plan to grow at a certain rate so that there's enough money to pay the promised benefits in retirement years. But if for whatever reason you're unable to generate enough returns, you're going to have a deficit because the pension is promised, but the assets that are supposed to allow for this payment of the pension can be variable. It depends on how the stock market is doing. Depends on whether you contributed in a year or not. So if, because of various factors, you don't have enough money, then you have a deficit. And what the law allows pension customers, our customers, to do is to write another check called a special payment into the pension fund and claim that as a corporate tax deduction, which is amazing because if I have an RRSP, I max out my RSP every year, and then because of some event that's not in my control, something happens in Russia attacking Ukraine, like today, a 4-hour bombardment, and now NATO is scrambling jets. Well, that may have an impact on the stock market if things get worse. If my RSP account melts in half because of international tension, I'm not allowed to put more money in my RSP because I maxed out my RSP. But if I have a pension plan, I can backfill the losses with extra tax deductible money. So it's a huge, huge difference. Next slide. So now going back to the case study, what are those special payments in our 45-year-old study? Well, you can see them year by year. So you can see every 4 years when we do evaluation of the health of the plan, because we're using a 5%, remember I said the money's growing at 5%, not 7.5%. That's why every 4 years you can see extra amounts that the company can contribute to the plan. And when you tally them up over the 20-year period, it's an $85,000 of special payments. So that's $85,000 that you can't contribute, you can't claim a deduction if you are using an RRSP and you've maxed out your RRSP. Next slide. As for the pension adjustment offset amount, or the PA offset amount, that's just a small extra tax deduction that can be claimed every year. It's $600. So if you look at the column that says RSP contributions with the 3 stars, you see the $600 is added every year. That's an extra personal tax. So it adds up to about $11,500. But there's more. There's more because we're up to 5 now. So we're going to throw 2 more. So all of the investment management fees in a pension plan are tax deductible. They are not if you're using an RRSP. And the fees paid to my company, the annual administrative fees to keep this structure going and keep it compliant and interface with the government and all that, those are also tax deductible. So let's look at the investment management fees. Contrary to the RSP, the pension plan fees are deductible to the corporate entity that's sponsoring the plan. So if you look at the next slide, we have a numerical, some assumptions. So if we assume that the IMFs, or the investment management fees charged by Godfrey's company is 1.5, it could be lower, it could be higher, it depends on a bunch of factors, but let's assume it's 1.5 on assets. And let's also assume that the corporation that's sponsoring the pension plan is taxed at the lowest rate in Ontario right now at the corporate level, and the first $500,000 of taxable corporate income at 12.2%. What happens? Well, when you fully look at the math, you see 1.5% of the assets, and then you apply the 12.2% tax refund. So you can see how much money is saved. When you tally it up over the 20-year period, that's an extra $55,000 of refunded money, of CRE money, that wasn't part of the system before, because we were able to repatriate that. So that's the first thing. The INTEGRIS fees. So typically, for a single person in the plan, it's $2,800 tax deductible. So if you multiply that and then add the sales tax, the HST, the total bill for the 20-year period is $49,199. But when you deduct that at 12.2%, that generates a tax refund of $6,000, let's say $6,000 for the corporation. So if you look at the next slide, we pull it all together. Remember that the cost to INTEGRIS with sales tax is $49,000 for over 20 years, but we have a $6,000 refund for the fees and a $55,000 for the investment management fees. So we have $61,000 of total refunds. That's money coming into the system, minus the $49,000 to pay my company. So net of fees, the client ends up with $12,000 extra. In other words, it's auto financing. All the advantages that we're going to be talking about later on don't come at a cost. In fact, if you don't do that, you're looking at losing the $12,000 because you'll never be able to access those tax refunds. And there's one more deduction that I wanted to cover, and this is the most important one. It's called terminal funding. So let's go to the slide. Now, remember that we started saying that this is a 45-year-old that would like to retire at 65. If we followed the plan and the money grew at 5% and we did our special payments and blah, 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 and then you end up with X dollars by age 65, there's enough money in the pension fund to sustain an annual pension, a benefit of $188,980 a year. So that's the pension that's promised at 65. Now, we do have the option to index that with inflation protection. But in this particular case, we've crunched the math, and in order to completely protect that from inflation, there would be an extra cost of $330,000, and that's what we call the terminal funding contribution. So that's a $330,000 extra corporate tax deduction. So we take pre-tax money and we dump it into a tax-exempt pension plan. And now the pension plan is richer, so it can afford to pay an index pension. So let's say inflation in year one was, if you don't mind going back, going back the other way, yeah. If the inflation in year one was 10%, well, the $188,000 would now become $207,000. There would be more money coming out of the pension plan to make up for the cost of living. That's what indexing does. So that's why there's a cost to providing indexing. Next slide. Now that $330,000 extra brand new tax deduction, assuming again that the corporation is taxed at 12.2%, would generate a refund, another refund on top of the $62,000 that we were talking about earlier, of $40,262. Which, like, I wouldn't say no if someone wrote a check and said, here's an extra $40,000, thanks for being our client. Next slide. So to put it all together, remember that this business owner was facing a fork in the road. They had the RSP, where you max out your RSP every year, you grow that money at 5%, or they set up a PPP, also earning 5%. What happens? What are the two outcomes? Well, when you look at the math, the PPP customer has $2.8 million, and that's without the terminal funding. That's without the $330,000 for indexing. That's just the core basic accumulation. In the RSP, that same person would have $2 million. So right away, there's $855,000 in extra registered dollars that are now available for retirement purposes starting at age 65. So that's already a nice little, it's over almost, no, not quite a million, but we're getting close to $1 million of extra retirement dollars that are available. And if you translate that into an annual cash flow, how much money am I spending every year? We've already told you that the pension at 65 is $188,980. We could index it to inflation. The RSP, because you only have $2 million, using the exact same annuity purchase, would be providing an annual payment of $140,000. So that individual is enjoying $48,000 more in terms of annual spending because they have a more generous pension. So that's not bad. To me, I find that material. Some people may disagree, but I would rather be the PPP than the RSP customer. Next slide. But that's not the end of the story, because there are a whole bunch of other tax advantages that stem from being in a pension plan that we now have to look at. So remember, this 65-year-old is collecting an annual pension of $188,980. If that person took all of that on their tax return in Ontario, the total combined federal Ontario tax for that pension would be $61,687. However, because this is a pension plan, this individual is allowed to income split half of that 188 and move it to the tax return of the spouse. So maybe the spouse is stay at home and has no income. So now if we do that, the member and the spouse pay tax on half. And the combined tax for the couple is $40,712. So if you look at what he was supposed to pay, $61,687, and what the couple ends up paying, $40,712, it's as if we had generated almost $21,000 of tax savings, dollars that we no longer have to pay CRA, that we're keeping in our pocket every year. So that's, nothing to sneeze at, in my humble opinion. Now, there's more, because if you remember when I was talking about the assumptions, I said that there's $100,000 of retained earnings and the corporation has a non-registered corporate investment account. And with that 100,000, they're buying shares, they're investing to build up more wealth. So in this case, shares were worth $100 when they were purchased out in the marketplace with $1,000 shares, and now they're worth $300 per share. So the initial $100,000 investment has ballooned into an unrealized gain, if we were to cash out all those shares, of $300,000. And because the pension plan is hungry for money, the corporation decides to sell those shares out of its non-registered taxable account. So what happens? The proceeds of disposition, so selling those 1,000 shares that are now worth 300 gives you $300,000 of cash. The adjusted Scott's base is what the company had paid for those shares, 1,000 shares at $100, it's 100,000. So the capital gain, the difference between the two, is 200,000. But the law, unless Mr. Trudeau decides to change it in the next budget, the law still says that only 50% of that capital gain is taxable. But if we're contributing $300,000 to the pension plan, the company has a tax deduction of $300,000. It only has to pay tax on $100,000, but now it can claim a deduction on $300,000. I.e., in other words, there is no tax. In fact, there might be even tax losses, which would entitle the company to get a tax refund for previously paid taxes in the past 3 years. But more importantly, because only 50% of that $200,000 capital gain is taxable, the other $100,000 is a capital dividends account credit, which means that this 45-year-old, well, 65 if we push this to retirement, depending on whenever we do this, would be able to pull out $100,000 tax-free from the pension plan, even though the company did not spend a penny in taxes on liquidating those 1,000 shares. That's pretty good. Who doesn't want $100,000 tax-free income? All right, but there's more. There's more, because now this business owner who turned 65 has decided to retire in the south of Portugal. and they have this $188,000 a year pension, as a non-resident of Canada, under Part 13 of the Income Tax Act, there's a flat 25% non-resident withholding tax at source on that $188,000 a year pension. Luckily, Portugal is one of 100 countries around the world that has negotiated special rules when it comes to pension income. So if you're a non-resident, like this guy living in Portugal, the tax rate in the treaty between Canada and Portugal is 15%. It's the same thing for the US. It's the same thing for France. It's the same thing for many, many countries. So the only tax paid to Canada is $28,347, not the $61,000 that I was talking about earlier. And because they're not paying the flat 25%, they're only paying 15%. That's another $18,000 in annual taxes saved. So if you're a non-resident, seriously consider getting a Canadian pension. Next slide. Now, the other thing too is a lot of people don't know this. Many do. Many accountants do know this. When you become a non-resident, the Income Tax Act has one last surprise called a departure tax, which is a deemed disposition on your wealth unless you can classify your assets as being exempt assets, exempt from this tax. Well, lucky for us, the entire $2.8 million that's sitting in the pension plan is considered an exempt asset under the departure tax rules. And if the deemed disposition works out to a 25% tax rate, we just saved this particular individual another $718,000 in taxes when they decide to cross the border and became a non-resident. That to me is a nice gift, a nice departure gift. Next slide. Remember the child? We were saying 20-year-old child on the payroll. So if the child of the owner works in the corporation and collects a salary, and it could be minimum wage, could be part-time minimum wage, doesn't have to be a big salary, as long as it's legitimate when it comes to claiming that salary is a deduction for the corporation, they can be added to the plan, to the PPP of the father or mother, the plan member. Now, should the business owner pass away, and here I'm going to use an extreme example. On the first day of their retirement, age 65, the business owner dies. So all the money, the millions of dollars in that account, is now exempt from the death taxes, the deemed disposition on death that's normally applies to RSPs or to RIFs if you don't have a surviving spouse to do a rollover to, right? Now, when you have to recognize RSP money into your terminal tax return, because it's deemed to be ordinary income in the year of death in the stub period, typically the tax rate is over 50%. So here we just saved the 20-year-old, well, they'd be older by the time he retires. He'd be 40 by then. We just saved that child, that second generation, $1.3 million in taxes. Next slide. So we're getting to the end of the formal presentation, and we wanted to reserve time for some questions. But what have we achieved? Well, for sure, we have significantly more annual retirement income, right? We saw that. And we have a lot more money that's registered, that's available for retirement purposes. And we've done this in a way that auto-finances itself. So we don't have to dig into our pockets to get those advantages. It's not a trade-off, right? This comes with the package. But perhaps more importantly, we've done all this while protecting against the departure tax if we ever decide to leave the country. And in the case of having put a child in the plan, protected against the death tax, the deemed disposition on death that's baked into the income tax legislation. And as a bonus, if we had used corporate non-registered capital assets to fund the plan, like we did with 1,000 shares, we've also created tax-free income thanks to the capital dividends account. So that's a lot. That's a lot of layers of value that are all form part of this one solution. Next slide. So that's it in terms of the formal, but I'm going to turn the mic over to Godfrey because I think there might be some questions.
Thank you, JP. It's really always good to know that we have different options to save for our retirement, and sounds like we are able to save a lot of taxes as well. And we'll see whether we have any questions, but please use the chat function to send us any questions if you have any. Well, let me ask you this then, JP. What happens if the professional or business owners, maybe there will be times where there'll be years that they cannot actually make that contribution? What happens then?
Oh, great question. So one of the things that I didn't say is that if you are a connected person, meaning that you own at least 10% of the shares of your own company, which 99% of our clients, they own more than 10% of their business. Under the law, the pension plan is exempt from the mandatory funding rules of the pension legislation. In other words, in plain English, the company doesn't have to contribute if it doesn't want to, or if it doesn't have the means to do so. So your question is, what happens if there's not enough money? The answer is nothing happens because there's no obligation. It's kind of like an RSP. If you have the money that year, you can contribute. If you don't, you don't. It's that simple.
Great. So that's pretty flexible then.
It's extremely flexible.
Okay, sounds good. And we do have a question here. So we obviously heard about all the benefits of the PPP, and are there any cons or disadvantages of this strategy?
There is one. It's not fees because we've proven that it auto finances itself, and that's without factoring all the other stuff, all the tax savings, the millions of dollars in taxes saved on top. So it's not the fee. The Achilles heel of the PPP is that because it's such a sophisticated pension, there's a lot more paperwork upfront to get it registered with a CRA than you would with an RRSP. An RSP, you can go online and in 10 minutes, you can open up an account. With this, we have to collect, especially if you're buying back past service, we have to collect historical T4 slips. We have to get your notice of assessment. We have to get your RSP statements. We need the articles of incorporation of your company. We need your business number. We need to provide a trust agreement, an agency agreement, a statement of investment policies and procedures, a plan text, all this paperwork that needs to be set up and signed. You don't have that if you do an RSP. Now, we don't charge you for that. It's part of the annual fee, which it's auto-financed anyway. But, for some people that are busy, that don't like paperwork, that could be an irritant. Now, luckily,
it's more
over
like an
time,
administrative.
well, upfront, just to set it up. After that, it's okay. But for the first year, when you're setting it up, there's a big amount of work. Now, luckily, we used to have to do this all with paper. Now we do it all with electronic signatures. So it's not as bad as it used to be, but it is the Achilles heel of the PPP.
All right. And other question. So what happens to the plan if I sell my business or if I retire from professional practice?
Well, so first of all, if you keep your company and sell the assets of the company, this morning I was talking to a franchisee who was thinking in a couple of years of selling the assets of his franchisee, the book of business and the systems and all that for money. Nothing happens because the plan is attached to the company. So the company continues to live on. If, however, you decide to sell the shares of your company, The way that we tell our clients to set it up, set up the pension plan is we have a holdco or a numbered company or personal company as one sponsor, and then the business as a second sponsor or participating employer. So that if you ever decide to sell the shares of the business, the sponsoring company, the holdco, would continue with the plan. So there'd be no tax consequences. You wouldn't have to wind up your pension plan. So that's the cleanest way of doing it. Some people might say, well, I don't want to have a holdco. I don't have one. I don't want to set one up. I don't want to pay the accountant. What happens if I sell my shares? So the next option is to incorporate a company and assign the plan over to the new company. So that's also doable. So some people will say, no, I don't want to incorporate a new company either. I just want to get rid of this pension plan. What happens? The answer is called wind up, a termination of the plan. So what happens is you can take all your money and buy an annuity, and the annuity will pay you a pension. Or if you don't want to do that, you can transfer most of your money tax-free into an RRSP or RIF, and then the rest is a cash payment. And you do have to pay tax on that cash payment, though. And in which case, the plan is dissolved and the company is sold, and the new owner of the company doesn't have to worry about the pension plan because it's gone.
I see. Okay,
So
so
lots and
nothing's
lots of
lost.
options.
It's just, yeah. So nothing's lost. Just a matter of how you actually structure it at that point.
Yeah, structuring is what makes the difference.
Mm-hmm.
We have one question from the audience here, guys, from the chat we'd like to put to you. What investments are eligible for this, and are there restrictions on what investments?
Yeah, so good question. In terms of investments, the universe of investments within a PPP are much, much broader than under an RRSP. Under the RRSP rules, they're called the qualifying investment rules found in the income tax regulations. There's a laundry list of what's permissible for an RRSP account to invest in. And most of it is the vanilla stuff that everyone knows, like stocks on a stock exchange, right? And there's a bunch of other things. The pension plan isn't governed by those RRSP rules. They have their own set of investment rules, which are a lot more permissive. So with the pension plan, my customers can invest in stuff that's not RRSP eligible. Like, for example, if I wanted to buy raw farmland, because I know that north of Toronto, subdivisions are going to be coming, and these unprofitable farms need to sell their land. I could buy the land as an investment with pre-tax pension money, hang on to the land until a developer knocks on my door and writes me a massive check, and the capital gain would be tax-free because the pension plan is tax exempt. So that's something I can't do with my RRSP. If I go to the Royal Bank or the CIBC or the TD Bank and I say to the branch manager, here's $1 million, open an RRSP. Oh, I'd like to buy some farmland north of Toronto. The branch manager is going to laugh me out of the branch and say, sorry, no can do. But a pension plan can do those types of investing. So it's a much broader universe. There are some restrictions, however. So what a pension plan is not allowed to do is to take that pension money and buy shares of the company itself, right? You can't do self-dealing. Or I can't take, let's say I have $1 million in my pension fund. I can't take $500,000 and say, oh, my wife just started a Tim Hortons. I'm going to give her company, I'm going to buy shares of her Tim Hortons company because she's related to me, right? I can't do that with my kids' company because these are all related party transactions, self-dealing, and the government won't allow that. But I can go into all kinds of stuff that I couldn't do with an RSP. Now, the other rule that's important for our pension investing is the concentration limit. So in order to ensure that pension plans are properly diversified, the law requires that no more than 10% of the cash be invested in a single security. So, for example, BRIX was a great stock until it crashed. A pension plan was not allowed to take 100% of the money and only buy BRIX stock. It could only take 10%. And the idea, of course, is if that stock tanks and you lose your shirt, 90% of the value is still, still there, assuming you didn't buy a bunch of BRIX type companies, Nartel and all the other ones. So there's this diversification concentration test of 10% that you have to be mindful of. But for most prudent investors, and Godfrey can probably comment on that, you would never do that anyway. So it's not really a very onerous test.
If you think of anything later, or if you want to find out whether PPP is a right strategy for you, please reach out to me, and we will help you assess your situation, and JP obviously will be happy to do that. And so once again, I guess, thank you for attending our webinar, and JP, thank you very much, and for a very informative presentation, and have a wonderful afternoon, everyone.
Okay.